Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really glad that you could join us today. We are trying to help people with their retirements, especially in the financial sense, right? We talk about retirement planning, investing, tax planning. So those are things that you can ask us questions about. That's how we handle the show. We get questions during our strategy sessions with the clients that we'll include. We get questions emailed to us. You can use this Ask Tom at talkmoneywithtom.com during the week, and we try to answer those. You can send those in now if you'd like, or even go to the chat and put in a question. We'll try to answer it live. We've been doing this for a while. We've got this channel now, Talk Money with Tom channel. And the reason we put together the channel was just to, further the education in these areas. I put out a video every day on what's happening with the market. And, we talk about on the show a lot of the other planning and other areas also. So you can subscribe to that channel. Hit the bell button, get notified whenever we put something new on there. Take a look. I think we're over 1,500 videos on there at this point. So I think it's probably a good resource for some of the things that you might be looking for. And then lastly, of course, if you have some personal questions or things that you want to ask us directly, you can just set up an appointment. We have a book appointment button, on our website. It looks just like that. The website link is here on the channel too. And our schedule's there, and you can set up half-hour time to just ask us some questions on phone, video, in office, whatever works for you as far as that goes. So anyway, that's what's happening today. I really hope there's something that everybody can grab onto today and kind of try to improve their retirement, whether they're already in retirement or you're looking forward to retirement. A lot of this advice works for both groups as far as that goes. So do like to start off every show with kind of a summary of what we've seen happening in the market. So it's been a couple of weeks since we've had the show, and I didn't do a summary last week. Last week turned out to be the best week since November of last year.
Yeah, maybe we should take time off more often.
I guess so. And it was an amazingly strong recovery week. This week's been pretty decent also, actually, and if you look at the chart here, obviously we've got a lot of data up here with the pandemic drop and then, the big run up and the fall for the inflationary period in 22, et cetera. But if we look here at the very end, you can see that, we're making another V recovery. Okay. Yeah. Those are not that common. If you look at that chart, you can see some, but they're not as common as kind of the more, testing new lows and kind of come up a little bit and then fall back down and come up a little bit, fall back down. Sort of like what we had last summer was much more typical.
Yeah, a couple months of more of a deterioration of the market.
Yeah, we could still be in for that. We have not set a new all-time high here yet or closed above that. We're within, less than 1% from doing that. Hopefully we'll do that, next week or what have you, because that's an important point. We don't want to get right up to the top here and then fall back down. You kind of get this double top thing going, right, which the market would be concerned about. So I do think it's important. So yesterday, we had a 1% drop in the middle of a really good week, actually green all the way across except for yesterday. So there's some concerns there, hey, are we making a double top? And, we'll have to see until you get through. You have to wait. But if you look at kind of what's happening altogether in terms of the primary trend, going back to October 13th of 2022, which is where that first arrow is, every low that has been coming along has been higher than the previous low, including this last one. If that one is the one that holds, we'll have to see. We're still kind of waiting to see if that's a low. You need to reestablish an all-time high to kind of call that, but I put that arrow in there anyway. And so this is what we're waiting for, is kind of getting through that line to kind of get moving forward as far as that goes. So, there are some very specific things driving the market right now that are very important. And I think, sometimes the market just runs, and you get almost like this tulip mania, and it doesn't really make sense. And those are the scarier markets for me. Certainly the end of the 2000 market was just like that. It was just running to run, sort of a momentum piece. The PE ratio got way up there, like 45 times earnings. Right now we're in that kind of 18 to 20 times forward earnings, projections, which is not cheap, but not that expensive either. It's kind of closer to the average. If we look at kind of what's going on in the kind of the overall trends, our hourly trend went from red, which was turned red July 18th, back to green again on August 15th. So we always take a look at it break down into pieces. So, you're going to see your downturns come first in that hourly chart. Doesn't mean it's going to translate to anything. Matter of fact, that one didn't, right? But eventually, then all of a sudden, you got a daily chart that's turning red. That's your primary trend has just changed there. And so the hourly is more of kind of an early warning signal. We do use it sometimes for new cash coming in. We'll wait until that thing turns green because we don't want to buy a falling knife and come in, and have somebody's new money just turn into a 2008 downturn or whatever might happen, right? So we want to be a little careful. And then the market breadth indicators, looking at all these different ETFs, there's 8 different ETFs there. They haven't changed actually since we started this on June 3rd. Still have all green except for transportation, which is currently in a primary downtrend. Transportation is actually pretty close to turning into a primary uptrend, so even that one might turn green here too. So again, strong market. These aren't meant to be early warning indicators, these breadth pieces here. It's just more of confirmation of how bad this trend is getting, that type of thing. So you can kind of be aware of kind of what's happening across the spectrum. Is it just your stocks, or is it just the, sectors that you're looking at? What about the whole thing? How's that doing, right? And some of the major sectors that drive the market. So that looks good, right? That looks great to me, along with the chart being so strong. So the big thing probably this week, I believe, is really a couple of things that has to do with the Federal Reserve. So the Federal Reserve has a dual mandate, right? Keep inflation, in this case, core PCE inflation. And this chart goes back to the 1960s because there's some interesting history here. Keep inflation at 2% or less. So right now it's at 2.63%. And they'll be reporting it here next week again for July. We'll see. I think the projection is around 2.5% for July year over year. So that'd be nice. So you can see what happened here. We had a big period of time here with inflation being quite low. But this Federal Reserve has specifically mentioned that big chunk of inflation that happened earlier in this chart back in the 70s and early 80s. And what happens there, if you look, it's kind of interesting. What they're worried about is that first big bump that was in the late 60s, kind of coming down, started to come down by 1973, started to get down there. And they started to lower rates because the job market got softer. And then we had that spike straight up. And Chairman Powell specifically has said that they don't want to be a Federal Reserve that ends up doing that.
Yeah.
And so they want to keep the rates up for longer. Now, the difference, in my opinion, and why they need to be careful was, at least in my opinion, a big portion of that spike had to do with energy prices, oil prices going up. Oil prices went up from $4 a barrel to $40 a barrel in a 7-year period in there. And so if you think about it right now, if we're at $70-something a barrel, if it went to $700 and something a barrel, you would have an inflationary spike.
Yeah, a lot of people feared that with the Ukraine situation, that
yes.
kind of inflationary spike.
Yeah, we went to 130, but there was people calling for 260, 250. They thought this would happen, and there were some reasons to be worried about it because Russia produced 11% of the world's oil. And I think the reason that we're at 70 is, first of all, the U.S. is a net exporter of oil now. So we can kind of, let stuff go out to the rest of the world that needs it, specifically Europe. They were the biggest customer for Russia. And then, Russian oil still probably got out there in a lot of different ways. And matter of fact, it might have got out there at even cheaper dollar amounts, kind of at a discount, which maybe keeps the other prices down too. So nonetheless, I don't think we're going to have that same piece. And so the focus, the other mandate that the Fed has is employment, what they call full employment, which, is around 4.1, 4.2%, someplace in that neighborhood is what they're looking at for the unemployment rate. So they really don't want like 1% unemployment. Because then you got a tight job market and that causes inflation. So they do allow a certain amount of unemployment because that is healthy for the economy. It's not healthy for those people that are unemployed and those families that are dealing with that. But that's kind of how it works, and that's what they're looking at. And so this is the job market, okay, the number of jobs. There's currently 158 million people in the U.S. working, okay? Non-farm, total non-farm payrolls. And you can see it's actually, every time there's one of those gray lines, you can see the dip, right? That's a recession. So there's layoffs in a recession, unemployment goes higher, right? But overall pretty darn good path, right?
Yeah.
Really moving along nicely. And even, I'll zoom in a little bit here to see more close. So this is just from the 2008, see that gray line there, downturn to today, essentially. So you can see obviously the big drop that happened during the pandemic.
Yeah.
We had a 2-month recession in there, and we ended up with 22 million less jobs. So at the peak there, it's 152 million, and at the bottom, it's 130 million. So 22 million jobs disappeared just overnight, essentially. And so that's a pandemic. Now we're at 158 million jobs. We're actually above, where we were at the pandemic, which is great. However, one thing that strikes me is how unbelievably smooth and consistent that line is coming out of the 2008 downturn.
Yeah, it's just a steady growth up.
And that is through several different, that's Obama's second term, Trump's term, so it's different parties and, everybody's going to take credit for different things. But nonetheless, if you look at the long-term chart, job growth happens here in the U.S. pretty well. And so, but one thing, if you draw a little line on there, although we are moving, you can see we're starting to curve a little bit in there.
Yeah,
and
so slowing down.
We're not on track for being where we might have been prior to the pandemic to kind of get back up to that line. And so this is the key thing that the Federal Reserve is talking about now is, and so today was the Jackson Hole speech from Chairman Powell, right, for the Federal Reserve. And market dropped 1% yesterday in some concern. Almost all of it's coming back so far today. We'll see what happens by the end of the close. But what they were talking about was that, they're seeing some softness in the job market and that, it's time to make a change in the way that we're doing things. So they've been on hold basically since July of last year when did the last rate increase. And now September 18th is coming. And in his speech, he talked about I think he hinted towards a 0.5 point rate cut, depending on the August job report.
Yeah, I read something similar. If August is very softer, then they're going to go for a bigger cut.
Yeah, exactly. So their meeting is September 18th. We'll get the jobs report prior to that on a Friday, probably the second Friday, so something close to that meeting. So they'll have that data. And so, we're looking at a 0.5 to 1/4 point, probably rate decrease in September. Market likes that. All right. And so that's the big news is that we've gone from kind of focusing on the inflation itself to now focusing on the job market. And that softness in the job market is making, the market at the beginning of August here worry about possible recession.
Yeah.
Right?
People are fearful for their jobs. I know like right now it's spiking and people being scared for being laid off.
Yeah, exactly. And so that is the new shift. Now, we're pretty far from recession if you look at almost any measure that I can see. There's lots of predictions of recession indicators out there that have pretty good track records, but they don't include a pandemic. And that's what's kind of changed things here is just this whole pandemic situation where, consumers have continued to spend. So that's kind of what's happening. Market is very, very strong. We're making these V recoveries, which is really unusual, at least in my opinion. The strength is there. I'm having a hard time, though, seeing that strength continue just straight through the end of the year without any real hiccups or sideways motion or softness or 10% drops or, whatever might happen, only because we're in a presidential year. And in a presidential year, the market makes more than average, 11% in the second half, right, which is probably double average. But if you look at the stats, it's not even, right? September and October are soft months as people wait to see what's going to happen with the election. I mean, like in 2020, September, I think it dropped 9% and then came back, and then October dropped 10%. And then we had the election and we ended up with a good year. I mean, so what happens after the election, November 5th, is the market's most likely going to go up. So has happened every other, no matter who wins. Just because there's money that was kind of sitting on the sidelines, that was not going in September and October, that now comes in now that we know the scenario, because there's different strategies that you might do in terms of investing depending on who wins. So maybe you wait for some of that and whatnot. And so that's comes. And so oftentimes you'll have just a great stock market run, from the election to the very end of the year. But I'm having a hard time seeing this great run that we're on right now continue all the way from now to the election. We'll see. I have actually been probably too pessimistic, which is, saying something, because I started this show just to ballyhoo optimism about what was going right out there, even during the pandemic. However, I'm more used to these kind of downturns like we had last summer, where it takes a couple months, kind of jumps up a couple times, and then it fails, and it finally finds a bottom, and then we take off. But this market has just been so strong, we haven't had that. We've had these V recoveries. So who knows? Maybe we just keep on running all the way through the end of the year. That'd be great, as long as we don't get so far ahead of ourselves that we end up with an overpricing situation, which then requires a big sell-off to kind of take that steam off. So, we'll see. I am expecting the good results after the election, just based on almost every other election I've ever been involved with in my 37 years. Actually, I'm at 38 years now. I got my license originally in August 17th. All right, so that's what's happening here as far as I'm concerned. It's a great time to be an investor, really, to be out there. We're seeing lots of rotation things. Small caps running today, but it wasn't running for quite a while here. It ran back in July. There's things that are rotating around quite a bit. It's a good idea to be pretty well diversified with most of your portfolios and kind of own everything, in my opinion, in these environments where things are rotating so quickly. Utilities are great, and then they slow down a bunch, and real estate's pretty hot right now, for whatever reason, and how long that continues, it's hard to say. So we do little pieces in our targets where we move into those areas of high momentum, but most of the money we try to keep in these big, wildly diversified, pieces, so that you can kind of capture this movement no matter what. Because overall, you just want to be in the market, right? You don't have to be in the thing that's going the highest, the fastest. That'd be great, but oftentimes if you miss that, you miss the whole market move. So you do want to have your money in the market as a whole, and then maybe play around on the margins if you're going to do that. Would be my opinion. Is what we do. All right, so that's our summary for the week for what happened. I look forward to being able to talk about this again next week.
Can you explain in a little bit more detail how you decide to enter the market with new cash, when you get after that red signal?
Yeah, this really goes back a long ways for us. People, new clients, for example, or existing clients with new money. Somebody gives you $200,000. You don't want their next statement, if possible, to be 190 or 180 or something. Even though it might turn into 400,000 over the long term or whatever it might be, it's a bad taste, in sense of what's happening. And so we've always tried to be a little bit careful that we're not just buying at some topping point, and then once things come down. And so we have found some success really with, and I'll share this, with kind of looking at the hourly chart on the S&P 500. So you can see, the peak back there, that first red arrow was the 16th of July, which is really fascinating because you go back to 1928 and you look at the first 2 weeks of July, they're the strongest 2 weeks of any, the first half of any month historically. And that's because it's the end of a quarter and the end of a semi-year, half a year. And so, but historically, a weakness starts in the market on the 17th of July. And so that played out like exactly this year, which is kind of incredible. And so what happens is you can see it's not setting a new high. The next arrow didn't get there, right? It fails. The next arrow didn't get there. It really fails. That was the capitulation sell-off down there. Now it'd be great to go in there and buy, and people that are buying the dip. The problem is you have no clue whether that's the bottom or not. You could be, because once selling kind of catches on, you could have a big sell-off pretty quickly. And so you kind of want to wait, and you want to see that momentum shift. And so we're waiting for a new higher high in this situation, which you can see, and that happened on August 15th as far as that goes. And so I looked at it, actually, if you look at the the point that you would have bought versus the point that we bought, we got in at about 20 points less on the S&P, which is, not much, but it's still safer. And then this chart's dated, it actually continued to go up, right? So, and, you want, for me, I want to buy into those environments where there's a higher probability of success right away, right? I'm not looking to try to, get that bottom because I mean, where was it? I mean, it could have been after that first arrow. There's a bunch of dip buying that came in there, right, to create that little run up, but then it failed.
Yeah.
Okay, well, the next one, okay, it's down there. Well, you got a little run up. That's nice, but that failed, and it really lost money, right?
Yeah.
So I mean, and I know that dip buying is really common, but and I have no problem with dip buying as a whole. I hope everybody does it, but you won't catch me doing it as much, only because we're historians. We understand how this works. There are dips that can wipe you out. Look at 2000, look at 2008, and even during the pandemic, there was periods of time where there was little bounces and stuff. Those people got hammered. Long term, it works out, right?
Yeah.
But I'm just talking about somebody's, next statement and the statement after that and the statement after that. It's awesome if I can get those to be growing. It cements, a good relationship and a good feeling with the client. Even if I didn't get in at the bottom, I'm trying to find the places that have the highest probability of success.
Yeah.
Right. And it works most of the time, actually. That's why I'm showing it. It's a pretty good way of doing it. It's simple. And we basically have a scenario where once that hourly chart turns into a primary direction down, we freeze purchase and money keeps coming in, and we just kind of accumulate it, and then we buy it once it's settled, and we get a new high in this particular case. And we change the primary direction back to up, which is where it is now. Yeah. So anyway, it's that's a good question. It's very interesting. Kind of how that works. It's just something we've developed over the years that seems to work for us.
So, what were your takeaways from Powell's speech? It was a pretty influential speech in the markets today.
Yeah. So, yesterday the market drops 1%.
Yep.
Just before this speech, and if you go back to 2022, the market is coming down. We keep having these huge runs up, but they did their Jackson Hole speech. It was very negative, at least as far as the market was concerned. The market dropped 3% on that day.
Yep.
And it basically just continued to fall with a few, run-ups all the way till the low point that it hit on October 13th of 2022, which was about 15% below where that speech started. So, the market remembers. I remember. And so, there's some concern, what they can say. Now, if you look at it, they said exactly what you would think they should have said, because the labor market is softening. And so the biggest takeaway is this is the first time where they've almost outright said we're cutting rates, right? Almost always it's a hedging thing. Well, we're waiting for the data, we need to feel more confidence. They have all these things that they say kind of over and over again. But he basically said, hey, it's time for a change. It's time to start making those rate cuts.
Yeah, and some other takeaways he said was basically inflation's still not where they want it to be.
Right.
It's getting there, and they feel it's a sustainable path.
Right.
But it's not all the way down there.
That's right. Although they did mention, in earlier conversations that they don't want to wait for it to get all the way down there, because it might get a momentum that becomes deflation. That they can't stop, and then they're they're trying to catch up and doing big rate cuts, and so something measured. Looking back at it, they should have done a quarter point in July, and this week the minutes came out, and there were a couple of Fed governors who were advocating for a quarter point cut in July. I think they're right, and part of the reason the market had so much trouble at the beginning of August was because they didn't do that rate cut, and so there's this fear. But let's face it, the Fed almost to 100% degree messes up. This is the same Fed that should have been raising rates earlier and talked about transitionary inflation, didn't want to raise rates, took forever. It took almost a year, really, to get to a pure rate.
They did make, to talk about their mistakes, about raising rates and stuff like that, how they had to raise so rapidly rather than a slow, steady increase.
Yeah, I would say the other thing that was as a takeaway was kind of hinting that there might be a half a point rate cut based on the jobs report that would come for August. So August jobs report will come at the beginning of September. The meeting September 18th. So they'll have that. If that report is still soft, maybe below expectations, or I don't know what measure they're going to use for that, but they might be able to do, or feel like they're able to do, a rate cut of 0.5% instead of just a quarter. Again, they have a dual mandate, which is full employment and 2% core PCE inflation.
Yeah, I think this Fed is willing to have the market, go into a soft or a recession, but a more like kind of less severe recession, if it means that they fix inflation.
Yeah, I personally think that would be a mistake, because it could turn into a bigger recession than they think. And they're trying to avoid being that Fed that allowed inflation to spike again like it did in the 70s. And that spike was mostly, in my opinion, oil related. We're not having that situation at this point. I can't see oil going up 10 times its value like it did there in the 70s. And so I think that, this is predominantly a pandemic induced inflationary event. And I know the different parties are pointing fingers and trying to say, oh, you caused inflation, But the thing that kind of interests me is, if you look at global inflation, I mean, there was no one party. It wasn't the Democrats or Republicans that caused inflation in the UK, and in Europe and all these other places. You had a pandemic, and so you had, money flooding out from all of these central banks, right? That's pretty inflationary when you make money, more liquid, and of course lowering rates so much so people could get to it. And they could spend that money, but nobody wanted to go back to work because they either had money and they were okay, or they were worried about the virus, or both. And so it's taken a while to kind of unwind all of that. And so they have to be careful about leaving these rates up for too long based on the fear of what happened in the 70s, because they don't think that that's what we're dealing with here. We didn't have a pandemic in the 70s that caused this shortage of labor and shortage of goods and an excess supply of money at a cheap rate, right? Those are inflationary things. That's what happens. And so those have been reversed. We no longer have cheaper rates. We no longer have the real issue. Still got a lot of job openings compared to people that are looking for jobs. So, but it's getting back towards normal, closer and closer to normal.
It's slowly and steadily. And people are saying, just as like an anecdote that I've seen from friends that have been out of work, is saying they were applying to quite a bit of jobs, and it's been tough.
It is. And I think the jobs that are open aren't the jobs that your friends are applying for, right? I mean, that's because we've seen a lot of softness in the tech arena, for example. And I don't think those are the jobs that are in that 8.1 million open jobs. They're probably at restaurants and different service type businesses like that. And so, and so it's always that way. You can talk about the generic, across the board. However, even a generic across the board, the unemployment rate is starting to pick up, So there's some, disparity between, why is unemployment going up when there's still 8.1 million jobs? Is because, there are sectors of the economy.
And there's also more people entering the workforce. And so more people want jobs, then you only have the same amount of unemployment. You can get an increase.
Yeah. All right. That's a good question. What do we got next?
So where do you expect the bond market to go over the rest of the year or the next few months?
Okay, the bond market is pretty interesting. I remember one time somebody did an analogy. If the stock market is the size of a baseball, the bond market is the size of a basketball. And so a lot of people, matter of fact, almost every day I do a report on the stock market and not the bond market. And so a lot of people, including me, tend to talk more about the stock market, be more concerned about the stock market, even though the bond market is wildly important across the board to all of us, to pensions, to, almost all of us might have some bond exposure, right? And so, you look at bonds, and I've got a chart here I can show too. This is the Vanguard Total Bond Market ETF. It's the bellwether that we use as a benchmark, when we look at the overall U.S. bond market. And the bond market's so big. When you look at like the total stock market index, VTI, they own, I think, 98, 99% of the stocks. The bond market is so large, and there's so many illiquid pieces of it. You can't buy the whole bond market. But this is as close as it can get. I think it has 7,700 holdings or something like that. It's pretty high. So anyway, if you look at it, it's an amazing chart. Actually, doesn't look anything like the chart we were showing on the S&P 500.
No.
We had a massive run up that really started in 2019. I don't know if everybody remembers, but 2018, the end of the year, they were doing this tariffs on China. Going after China, tariffs, 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 and the market was falling. Right, it was down 20%, and the Fed was actually still raising rates at that time too. And then they finally realized what was happening, and at the very beginning, maybe even very end of 2018, they started to lower rates. And so we started to see, the bond market goes the opposite direction in price
Yep.
as rates come down. Well, that went all the way through, and then all of a sudden we had the pandemic, and they lowered rates to zero. And so, what a massive run up! I mean, this is bonds, all right? They're not supposed to do this. Really, if the bond thing just went sideways and never changed, you're making your dividend, right?
Yeah,
And that's the money. To have appreciation on top of a dividend, that's what happened in that run up. So, obviously, that got unwound completely. That whole bubble burst in 2022 as they were raising rates. And then we've been in this range bound thing for quite a while, right? Up until just really, a couple months ago, we've now broken out of that. So I expect that bonds will continue to do well here. And I think that, there may be some money to be made here also, because it's been a while since bonds have really kind of performed to the level that you would like.
Yeah.
And when they lower rates, bonds do well, at least in terms of price. Your yield will continue to come down as new bonds are issued at these lower rates, but the price will move up for the older bonds. That's kind of how the market adjusts based on these things. So I would think that the money in bonds. I mean, if you look at the last 12 months, man, you're probably talking about on a world bond basis, maybe 9% return versus looking at the world stock market across the board. I think VT, which is the Vanguard, total world, is up maybe 22%. So, the stock market has been still wildly outperforming the bond market. But there could be a good argument to be made here, maybe not for shifting your stocks, but into bonds, but for staying with the bond market.
Yeah.
And continuing to let your money grow there. I think there'll be some good growth that could come out of that arena here as we go forward. And the bond market likes recessions in the sense that's why people have bonds and stocks, because stocks would maybe struggle more in a recessionary environment, whereas bonds, they're lowering rates in that environment to try to stimulate the economy, and the bond market can do quite well in that method also. So it's a good place. All right, what's our next question?
So, what are my options if my long-term care policy becomes too expensive with the recurring premium increases?
We've been getting this a lot because we have a lot of clients that bought long-term care insurance policies a long time ago, and they were selling those policies like hotcakes to a group, of 40 to 60-year-olds, I'd say, that wasn't going to be using it for quite a while.
Yep.
And now all of a sudden they got those groups, over the last 20 years that are now 60 to 80, and that's starting to be a situation where more and more of them are, using those policies.
Yep.
And these companies are waking up. And long-term care is probably a growth industry. Partly because they're the things that can cause sudden death, like strokes and heart attacks and even cancer, which isn't sudden but can be shortish, right? They're getting better and better at those, and so they're basically making it so that people are now, instead of dying from a heart attack, possibly ending up in long-term care and maybe even in memory care, which is the fastest growing area. It's all expensive, yeah. And these policies have caps, and they know how much they're going to pay out. It's just how many people are now being paid out versus maybe what they thought. So they're trying to stay in business, and they're doing that by basically moving the premiums up.
Yeah, and so basically, what these insurance do, they go to whatever state board. So for California, they go to the California Insurance Board and basically say, hey, we want to raise the rates for this class of long-term care policies. So they're not raising on individual people, but they're raising on kind of that class, so everyone that's in the same likeness or the same group. And they're saying they they can ask for whatever they want. They could say we want to increase it 100%, but California's insurance board will approve whatever amount, and once they approve it, essentially before the rate goes into effect, the long-term care policy, they have to do it within 60 days before 60 days they have to provide written notice of it before it goes into effect. And so what are your options when you kind of get this letter and you realize the premiums are too expensive? So California says, if you just can't pay any premiums, they have to offer you kind of like a paid up policy where you'll have some sort of benefit. It's pretty limited. It's based on how much insurance premiums you paid in, but you don't have to pay any more, but you're not going to get any more increase in your coverage, essentially.
Yeah, so that option, zero premium going forward,
Yeah.
right? Limit your coverage less than you've got, but basically they're just giving you credit for what you already paid, which is great. So they're not just like, hey, it's going to be 100% higher, and if you don't want that, you're out.
Yeah.
Right? You do have an option often to just be able to keep it and not have any premiums, and at least have some coverage.
Yeah, and so they have to work with you to kind of figure out, how do you keep this policy? Is your current premiums, within your budget, right? Let's say they are. Can we change how your policy is structured so that we can still, as a company, afford it, but maybe you can still have insurance? And so that could be whether, so there's kind of some variables you have your benefit period, your daily benefit, your inflation protection, and so they can start to reduce these and change these little factors to kind of get to a policy where they can quote you at the same premium.
Yeah, so for example, if you're $6,000 a year and they come to you and say, hey, it's going to be $10,000 for that now, or whatever, and so you say, well, I could afford the $6,000. I've been paying the $6,000. And so you go to the insurance company and say, what can I get for $6,000? That's basically what it comes down to. And so, they manipulate different pieces of it, because they know all the actuarial stuff behind the scenes, and maybe they're getting rid of your, cost of living increase that you've got on the benefit or whatever. There's a whole bunch of little pieces.
You could be like, hey, I have a 5% inflation premium.
Right.
We'll lower to like 2% instead. Right. And so it's cheaper for the insurance company in the long term because they just don't have to keep ratcheting up your benefit. Yeah,
it reduces their future liability, which is what they're looking at. So, yeah, I think it's kind of interesting how this is working, and this is a good question actually, because we're getting a lot of concern from clients. They're getting these big notices, and some of them aren't that great at describing what you can do.
Yeah.
And almost every single time that we've dealt with a client, get on the phone with a company or what have you, it's worked out pretty well. Clients seem to be satisfied.
So, these companies, they're trying to send you an advance notice so you have time to kind of make these adjustments.
Yeah.
And so you can work with your, whoever's your broker or your advisor, and then you can kind of use these conference calls and just ask questions. What are my options available to me? What's the paid up option? What's the reduced benefit option? What can I change to kind of maintain these policies?
Yeah, I think it's a great subject. I'm telling you, if you haven't gotten a notice yet on your long-term care insurance policy,
you're
likely to. It seems like we're getting almost every client that has one has been getting some kind of notice. So.
Yeah, and the point of these policies are to kind of protect your partner in a sense. You don't want to, if one of you went into long-term care, you don't want your asset base to basically be depleted, and your partner still have to live on a depleted asset base.
Yeah, exactly. All right, what's our next question?
So I'm thinking about downsizing and moving to be closer to my children. What are the pros and cons of renting versus buying?
Interesting. Okay, so if we rent, we have no massive capital outflow, theoretically, right? We don't have to put down a down payment or buy it with cash. We have kind of known maintenance costs, which should be basically zero in the sense that you don't have to, you just call the landlord when the toilet breaks or the roof gets blown off or whatever happens. So you don't have, you basically have a more known surprise cost situation that you would have as a renter. Your total cost of ownership could be less, or of housing, I should say, could be less, depending on what type of, what market you're going into, right?
Yeah.
I mean, here to buy versus rent, it's pretty hard, right? I mean, the rent is still really high, but buying is even higher.
Yeah.
Yeah. And so it depends on what market you're moving into as to how that might work. You can look at that from almost a percentage basis, right?
Yeah. But one con of renting is that your rent can go up each year, or basically each lease term.
Yeah. So, I mean, if you have a 3% increase in your rent will double in 24 years, just as a, an example. So whatever rent you're paying, you probably feel like it's fairly high. Well, it can double,
Yeah.
and so it depends on the landlord and the inflationary environment and what's happening in the supply and demand of rentals.
Yeah.
There's a whole bunch of things that factor into that. But overall, that's the probably the biggest downside. I think part of that's too, like age. If I'm 80, versus 50, so how long am I going to be renting, and how long am I going to be exposed to that inflationary pressure on the rents? Obviously the other big disadvantage of rents is if you move to an area that has some appreciation in the house prices,
Yeah.
at least, maybe you don't get it, but your estate gets it, if you don't sell it. But although if you're there for 15 or 20 years and you get some appreciation and all of a sudden you have to go into a nursing home, now you just got some money from an investment standpoint that turns into a nursing home. Now, we live here in Silicon Valley. We all think real estate goes up, period, because it has for our whole lives all the way through. But that's not true everywhere. That's definitely true. You look at the stats, different places in the country, you might be buying a place that's actually worth less after all the maintenance costs that you put in, as far as that goes. But, so that depends on the area, depends on what the appreciation has been, at least historically. And so that's a disadvantage of renting, is that you're giving up that possibility of appreciation.
Yeah, and another disadvantage of renting is just if you want to remodel or do kind of updates to the place, you're up to the whims of your landlord. You really don't have that kind of option. Either you just move to a different place that's been upgraded. You don't really have a say in what gets done as much.
Yeah, so it's almost like a personality thing. Do you really like, hey, doing your yard and doing the house and fixing stuff up and painting this, I think, that's a cool part of owning a home. You get to decide that, right? But some people are like, I don't want to decide that. I just want to live there and, and have my stuff there. And if something breaks, I just want to call somebody. But yeah, that's a disadvantage. If you're one of those people that really likes to nest and set stuff up, and, I'm sure there's things you can do in terms of some gardening and stuff, but some structural things you probably have to at least get approval for, which you wouldn't have to if you were the owner.
Yeah, and so it's kind of like when you're buying, it's kind of the inverses of the cons and pros.
Yeah.
So when you're buying, you have the ability to kind of fix your costs in a sense. Property tax and maybe your utilities will steadily go up, but you're kind of that big capital payment or mortgage is going to kind of stay fixed.
Yeah, that's right. So if you're going to be in this place for 20 or 30 years, possibly, you're going to have, assuming you had a mortgage, you're going to have the same payment on a fixed mortgage basis. You might even be able to lower it if rates come down. You can refinance it, and that type of stuff, but it's more controllable. You don't have that ever increasing rent possibility that's facing you. So it's a tough question to answer as a generic question. We're trying to point out, the pros and cons, which I think is the best way to answer this. But it really depends on, who are you? What do you like? What do you dislike? Where are you going, right? And what's that market like? What's it like to purchase there versus rent? So
how long are you going to be there? How old are you?
You go to a place where rents are $2,000, and the same place can be bought for $200,000, buying seems like okay. You go to another place where, the rent's $5,000, but it's $3 million to buy the place.
Yeah.
That's, so it really depends on where you're going as to, what makes more sense as far as that goes. So anyway, that's how I would look at it, and those are all the pros and cons that I can think of.
Yeah, and these are kind of questions. If you have an advisor, they could give you a very specific answer to your situation.
Yeah, exactly right. Exactly right. Okay, that's the end of our show. I want to thank everybody so much for joining us today. There were some really good questions today. I think hopefully people got something out of this. Send in your questions. Anything that comes up that you can think of that fits in that, retirement planning, investing, tax planning categories, we're happy to answer those. And so you can send them in during the week at asktom@talkmoneywithtom.com. Go to the channel, take a look at what's on there. We've got, all kinds of videos on all kinds of subjects. You can subscribe to the channel, hit the bell to get notified when there's something new. And then obviously, lastly, you can set up an appointment with us. You go to our website. There's a link here on the page. And you go to the book appointment button, and our calendar's live, and you can set up a time to meet with us. So look forward to seeing you again next week. Thank you so much for coming today.